Hey, welcome. Today, we're going to crack open a crucial tool for any serious investor, the world of bonds. We're going to strip away all the complicated jargon and get right to the heart of what they are, how they work, and most importantly, why you should probably have them on your radar. Let's jump right in.
So let me ask you something. Does the daily roller coaster of the stock market make you just a little bit queasy sometimes? If you're looking for a way to bring some calm, some stability to your investments, you are in exactly the right place. Bonds, they might just be the anchor your portfolio has been waiting for.
So, here's our game plan. First, we'll talk about the why, the big advantage bonds offer. Then we'll break down what a bond actually is. After that, we'll see who's out there issuing them, learn the key terms you got to know, and finally, we'll get down to brass tacks, weighing the risks versus the rewards.
All right, let's kick it off with Section 1, Beyond Stocks. Look, the bond market might seem super complex from the outside, but its real purpose in your portfolio is actually incredibly simple. Here's the most important thing to get. While we often think of stocks for growth, bonds are all about stability. They kind of march to the beat of their own drum. See, by adding them to the mix, you're not putting all your eggs in that one very jumpy stock market basket, and that can really help smooth out the ride when things get choppy.
Moving right along to Section 2, I want you to forget everything complicated you've ever heard about bonds. We're going to break this down with one super simple, powerful idea.
That's it. It all comes down to this. Seriously, a bond is just a fancy IOU. I-O-U. If you can wrap your head around that single concept, you're already 90% of the way to understanding the entire bond market. You're the lender, and some big company or a government is the borrower.
So let's just make that official. When you buy a bond, what you're really doing is giving out a loan. And in exchange for your cash, the borrower makes you two promises. First, they promise to pay you regular interest payments for a certain amount of time. And second, at the very end of that period, they promise to give you your original loan amount back, in full. And this shows you the whole life cycle perfectly. Step 1, an issuer, say a huge company or even the government, needs money. Step 2, you, the investor, decide to buy their bond, which is you giving them that loan. Step 3, they pay you for borrowing your money with regular interest payments, and in the bond world, these are called coupons. And finally, Step 4, when the loan period is over, the bond matures, and bingo, you get your original investment back. See? Simple as that. Okay, on to our third section. Now, not all IOUs are created equal, right? Because they come from very different kinds of borrowers. Let's take a look at the main players you'll find in the bond marketplace. This table lays it all out. First up, you've got corporate bonds, issued by, you guessed it, companies. Their risk level is all over the map, from super safe all the way to really speculative junk bonds. And the interest you get? Usually taxable. Next are sovereign bonds, issued by national governments, like U.S. Treasuries. These are pretty much considered the gold standard for safety. And finally, you have municipal bonds, or munis. These are from local governments, they're also very low risk, and they have this awesome perk. The income you earn is often completely tax-free.
Now for Section 4. Every industry has its own lingo, and bonds are no different. But don't you worry, once you get these key terms from the fine print down, you'll be speaking the language like a pro.
First up is maturity. This is just the bond's lifespan. It's the end date, the day when the issuer pays you back your original loan, the principal, and that IOU is officially torn up. Bonds can be short-term, medium-term, or even really long-term, depending on what you're looking for. Next, we have the coupon. Think of the coupon as your paycheck for lending out your money. It's the fixed interest rate they'll pay you, usually once or twice a year, for the entire life of the bond. It's your steady, predictable income stream. Oh, this one is absolutely critical. Is the bond secured or unsecured? A secured bond is backed by actual collateral, like a physical asset. If the company goes under, you have a claim on that asset. But an unsecured bond? That's backed only by the company's promise and its good name. So as you can imagine, it's a whole lot riskier.
And finally, callability. This is a special clause in the fine print that lets the issuer pay you back early. Now, why on earth would they do that? Well, imagine interest rates have dropped since they first borrowed from you. They can call the bond back, pay you off, and then go issue a new bond at that new, lower rate. It's kind of like them refinancing their mortgage to get a better deal.
All right, our final section. And honestly, this is where the rubber meets the road for any investor. It's all about weighing the risks against the potential rewards. Time to balance the equation. Every investment has risk. For bonds, these are the big three. First is interest rate risk.
This one's huge. If market interest rates go up, your older bond with its lower coupon payment suddenly looks less attractive, so its price on the open market can actually fall. Just remember this, when rates go up, existing bond prices tend to go down. Second is credit risk. This is the big one, the chance the borrower just can't pay you back. And finally, there's prepayment risk, which is just that callability thing we talked about. They pay you back early, and now you have to find a new place for your money when rates might be lower.
So how in the world do you manage that credit risk? Well, luckily, you don't have to go it alone. You use bond ratings. Think of agencies like S&P and Moody's as credit score reporters for bonds. They give them a grade, from AAA, which is the absolute safest of the safe, all the way down to BBB and below, which are what we call speculative or junk bonds. Just a quick glance at that rating gives you a really powerful snapshot of the risk you're taking on.
Okay, we've covered the risky side of things. But what about the other side of that coin? How do we actually measure the good stuff, the potential reward of investing in a bond?
The magic word here is yield. Yield is basically the universal language for talking about a bond's return. And while there are a few different kinds, the most important one, the big one you need to know, is yield to maturity, or YTM. This calculates your total return if you hold that bond all the way to the very end. We're talking every coupon payment plus getting your principal back.
Now, just to give you the full picture, there are other yields you might hear about. Current yield just looks at the income you're getting right now. Nominal yield is just a fancy name for the coupon rate. And yield to call calculates your return if, you guessed it, the bond gets called early. They're all just specialized tools to help you get a clearer picture of what you might earn.
And before we wrap this all up, I want to leave you with a fact that might just blow your mind. We hear about the stock market on the news every single day, right? Well, guess what? The global bond market is actually way bigger. It's the quiet giant of the financial world. So there you have it. We've gone from a simple IOU all the way to understanding yield and risk. You now speak the fundamental language to navigate this absolutely massive and important market. So the only question left on your screen, now that you know how this works, what role could bonds play in your financial story? Thanks for tuning in.